Hey everyone, it's Theory. Today we're breaking down the strategies of a financial giant, Warren Buffett. His approach, as methodical as it is disciplined, is fascinating and within everyone's reach. In this video, we'll dive into the heart of Warren Buffett's 7 golden rules for building your own financial empire. Get ready to take notes, because we're going to unlock the secrets to lasting financial success. Before we talk about stocks or real estate, it's crucial to understand the financial basics. Warren Buffett, one of the most respected investors in the world, emphasizes strong foundations. Good budget management is like building on solid rock. It means knowing exactly where every dollar goes and making sure your spending doesn't exceed your income. This gives you a solid base for making smart financial decisions. Next, debt. Debt can be a powerful tool if managed well, but it can also be a trap. Buffett is clear: avoid high-interest debt. These debts can quickly become unmanageable and prevent you from reaching your financial goals. Every dollar spent on interest is one less dollar to invest. Investing is essential to grow your money, but it shouldn't come at the expense of your financial stability. Finally, integrity. A fundamental principle for Buffett. He prefers to work with honest and competent people. Integrity in business creates an environment of trust and mutual respect. Trust and reputation are far more valuable than a few dollars saved. Establish a budget, eliminate your debts, and invest in relationships based on integrity. By following these principles, you can build a solid foundation for lasting financial success. Surround yourself with people of integrity. Manage your finances carefully and avoid the traps of debt. This is how you lay the foundations for success. The stock market is influenced by our emotions, fear and greed. Buffett understood that you have to control your emotions to succeed in the stock market. He encourages us to see the market as a way to buy shares of companies at a price lower than their true value. This is value investing, an approach inherited from his mentor, Benjamin Graham. By keeping a level head and focusing on the intrinsic value of companies, you'll be better prepared for market fluctuations. In the beginning, Warren Buffett practiced cigar butt investing, a method of finding undervalued companies with one last puff of value to exploit. This strategy, although effective in the short term, focused on struggling companies, often overlooked by the market. But this approach has its limits. The companies found were often in decline, with little prospect of long-term growth. Investors had to constantly look for new opportunities, which could be exhausting and risky. Finding these cigar butts was becoming increasingly difficult, and the growth potential was low. Undervalued companies didn't always guarantee a satisfactory return on investment. That's when Charlie Munger, his longtime partner, introduced him to a new path. Rather than focusing solely on price, he suggested buying quality, well-managed companies with a sustainable competitive advantage. This approach emphasized intrinsic value and the company's ability to grow and thrive over the long term. This change in strategy was crucial to Buffett's success. By focusing on strong, well-positioned companies, he was able to benefit from the continued growth and financial stability of these companies. By prioritizing quality over price, Buffett benefited from the exceptional growth of companies like Coca-Cola and American Express. These companies, with their strong brands and efficient management, have offered substantial and sustainable returns. Investing is a journey, not a destination. The ability to evolve and adapt your strategy based on market conditions and new information is essential for long-term success. You have to know how to evolve and adapt your strategy. By adopting a flexible approach and remaining open to new ideas, investors can successfully navigate the complex and ever-changing world of finance. Warren Buffett focuses on what he knows. He invests in companies whose business model, market, and competition he understands. His circle of competence. You don't need to be an expert in everything. Focus on the sectors you understand, where you have an advantage. Passionate about technology, you might have a knack for identifying promising companies in the sector. Do you work in healthcare? You have a better understanding of the trends in this field. The important thing is to stay within your circle of competence. Focus on your strengths to maximize your chances of success. We often talk about errors of action, but Buffett warns against errors of omission. These errors are often invisible, but they can be costly in the long run. Missing an opportunity due to hesitation or lack of research can be devastating. Imagine not having invested in a company like Apple or Amazon in their early days. The stock you should have bought, the one that could have transformed your portfolio, is often the one you ignored. Buffett compares these missed opportunities to missed fastballs. In the business world, as in baseball, there are times when you have to act quickly. You won't hit a home run every time, he says, but the important thing is to be ready to seize opportunities when they arise. But be ready to swing when the opportunity arises. This means being constantly vigilant and informed. These errors are difficult to measure. They don't show up immediately, but their impact can be felt years later. The solution? Be prepared. This means doing thorough research and staying informed about market trends. Do your research, identify the companies that are right for you, and set an action plan. A well-thought-out plan can help you avoid errors of omission. When opportunity knocks, swing. Don't let fear or uncertainty paralyze you. Be ready to act and seize the opportunities that come your way. The best opportunities often arise when others panic. Be greedy when others are fearful, according to Buffett. This requires courage and conviction. You have to go against the grain and buy when everyone else is selling. Buffett compares these moments to exceptional sales. Why wait for the price to go up to buy shares of companies you admire? By keeping a level head, you can turn these difficult moments into opportunities for growth. Investing is a marathon, not a sprint. Time is the friend of wonderful companies, says Buffett. Patience is essential. Don't buy a stock to sell it quickly. Buy if you believe in the company's long-term potential. Long-term commitment avoids unnecessary fees and benefits from compound interest. More rational decisions. The longer you hold your investments, the better your chances of generating good returns. Patience is a virtue, especially in investing. At the heart of Buffett's philosophy, intrinsic value, the true value of a company taking into account its assets, future earnings, management, and competitive advantage. The stock market often has difficulty assessing it correctly, overvaluations, undervaluations. The investor must analyze companies and identify those that are trading at a price below their intrinsic value. Understanding this value allows you to navigate market fluctuations, informed decisions based on logic.
There you have it. You now know Warren Buffett's 7 golden rules. Investing, a marathon, not a sprint. Patience, discipline, and a thirst for learning. By consistently applying these principles, you'll be on the right track. So, get started, learn, invest, and build the future you dream of. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications to stay informed with Financial Freedom Flow. Together, let's build a path to financial independence step by step.